Article 11.3. Now, while the right of the source state in cases mentioned in paragraph 11.2 exists, in some of the cases there is an exemption in the source state for certain interest. When we refer to this interest, it is basically referred to for funds which might be given by one government to some company in the other state, whether it is the United States government or maybe the Indian government, which is putting in some money where they derive interest. Not only the government, it could also be in some cases certain institutions like the Reserve Bank of India for whom this interest exemption may apply. Notwithstanding the provision of paragraph 2, which gives the source state a right to tax interest under the conditions which are mentioned there, of this article, interest arising in a contracting state, okay, and falling under A or B shall be exempt from tax in the first mentioned contracting state. And what is the first mentioned contracting state? It is the state of source. So like I said, Article 11 paragraph 3 provides an exception to paragraph 2 whereby certain interest which would otherwise have been taxable in the source state is not so taxable. Now let's see what are these interests. Interest arising in a contracting state and derived and beneficially owned. Both these conditions are cumulative by the government of the other contracting state. So it could be either the US government or the Indian government, whichever one you are looking at, a political subdivision or a local authority thereof, of the government, the Reserve Bank of India. So if RBI gets some interest income from a company in US, it will not be taxable in US. Or the Federal Reserve Bank of United States, as the case may be, and such other institution of either contracting states as the competent authority may agree pursuant to Article 27 Mutual Agreement Procedure. So if interest arises in the source state and is received, okay, derived and beneficially owned by any of the following, then in such a case, it will not be taxable in the source state. The idea is that most of these institutions in their own country are actually exempt from tax, right? So any withholding tax which is applied in the source state may not be available as a credit for them. And to promote international trade, it is generally a bilateral exemption which is given by both the parties to each other for certain institutions. With respect to loans or credit extended or endorsed, right, by the Export-Import Bank of United States when India is the first mentioned contracting state, by the Export-Import Bank of India, the Exim Bank of India, when United States is the first mentioned contracting state. So if either of these two banks either by themselves give a loan or they endorse it, right, and to the extent approved by the government of their state and derived beneficially owned by any person other than person referred to in subparagraph A and B, who is a resident of the other contracting state, provided that the transaction giving rise to debt claim has been approved in this behalf by the government of the first mentioned contracting state. So first, Exim Bank of US, Exim Bank of India, and third is if the government of US or India approves a particular loan, right, where the interest is derived and beneficially owned by a person who's a resident of a contracting state, right, where this is approved by the government, then in that case also this exemption in source state shall be available.